Home prices are falling in Arizona, but the cost of owning a home is exploding. Your house may be worth less than last year, yet your monthly bill is higher than ever. Insurance premiums are rising faster than mortgages. Taxes are climbing while equity disappears. What was sold as affordability is quietly turning into financial pressure. This is not a market correction that rewards patience. It is a reversal that punishes anyone who believed lower prices meant lower risk. Across Arizona, homeowners are discovering a brutal paradox. The cheaper the house becomes, the more expensive it is to keep. So, which cities are draining household wealth even as prices fall, and why is this happening right now? The downturn unfolding across Arizona is not an isolated event. It is part of a broader reset in the U.S. housing market, one defined less by collapsing prices and more by collapsing assumptions. For more than a decade, housing operated under a simple formula: low interest rates, steady population growth, and investor confidence would absorb almost any amount of new supply. That formula broke the moment rates reversed. Mortgage costs jumped from historic lows to levels most households had not budgeted for. At the same time, the migration wave that fueled Sun Belt expansion slowed sharply. Remote work lost its momentum. Office return mandates quietly rewired demand back toward established job centers. Yet construction did not slow fast enough. Across fast-growing regions, developers continued building based on yesterday's demand. Entire subdivisions were approved, financed, and partially completed just as buyer traffic vanished. This mismatch, too much supply chasing too few qualified buyers, is now visible in swelling inventories, stalled projects, and deepening price cuts. But falling prices alone do not explain the pressure households feel. The real shock is the cost of ownership. Insurance premiums have surged nationwide, driven by climate exposure, rebuilding costs, and insurer withdrawals from high-risk markets. What used to be a secondary expense has become a dominant monthly burden. Property taxes followed a similar trajectory, recalculated off inflated pandemic-era valuations, even as market prices retreat. HOA fees and special assessments are rising to cover deferred maintenance and infrastructure strain. The result is a paradox few buyers anticipated. Homes are cheaper to purchase but more expensive to hold. Investors recognize this first. Short-term rental returns weakened as travel normalized and regulation tightened. Vacancy rates rose. Cash buyers, once willing to absorb volatility, began demanding steep discounts or walking away entirely. As capital retreated, it left owner-occupants exposed to a market no longer supported by speculation. This cycle is different from past corrections. In earlier downturns, lower prices restored affordability and pulled buyers back in. Today, affordability does not return simply because prices fall. Monthly carrying costs remain elevated, and confidence has been replaced by caution. That is why this reset feels slower, heavier, and more psychological. It is not driven by panic selling, but by exhaustion. Buyers hesitate. Sellers wait. Builders pause. And households caught in the middle quietly reassess decisions they once believed were safe. If this analysis is useful, take a moment to like the video, subscribe to the channel, and turn on notifications. The next 7 case studies reveal how these national pressures play out, city by city, household by household. 1. Phoenix. For years, Phoenix was the engine of Arizona's housing boom. It absorbed migrants from California and the Midwest at a pace few U.S. metros could match. Prices surged. Bidding wars became routine. Between 2019 and 2022, owning property in Phoenix felt less like a financial decision and more like a guarantee. That assumption no longer holds. By 2025, median home prices in Phoenix had already fallen roughly 15% from their peak. Inventory has doubled, and the frantic competition that once defined the market has vanished. Homes now sit for months in suburbs like Goodyear, Surprise, and Peoria, areas that were built on the expectation of endless population growth. Yet the real pressure is not the price decline, it is the cost of staying put. A typical Phoenix home that cost around $1,700 per month to carry in 2020 now demands closer to $12,900 or more. Mortgage rates near 7% are only part of that increase. Insurance premiums in many neighborhoods have tripled, reflecting wildfire exposure, extreme heat risk, and rising rebuild costs. Property taxes recalculated at inflated values continue to climb, even as market prices retreat. For recent buyers, equity has evaporated while monthly obligations remain locked in. Some investors have already begun unloading rental properties at losses. Rental vacancies are climbing to their highest levels since the early 2010s, weakening what was once considered a safety net. Foreclosure filings are up roughly 20%, a quiet signal of stress beneath the surface. Phoenix is not collapsing overnight. It is grinding downward. Month by month, confidence erodes. Sellers hesitate to cut deeper. Buyers hesitate to commit. Builders wait with unsold inventory. The city that powered Arizona's rise is now confronting a slower reality, one where growth has stalled, costs remain high, and the promise of easy appreciation has disappeared. So if Phoenix is struggling under these pressures, what happens to the cities that depended on Phoenix's expansion to survive? To Buckeye. Not long ago, Buckeye was promoted as the future of Arizona suburbia. Vast master-planned communities promised attainable homeownership, modern infrastructure, and a lifestyle just far enough from Phoenix to feel spacious, but close enough to benefit from its growth. From 2019 to 2022, that vision attracted builders, investors, and first-time buyers at extraordinary speed. Then the assumptions broke, and home values in Buckeye are already down roughly 25%. With some partially built neighborhoods seeing declines closer to 30%. Inventory has exploded to nearly 4 times previous levels. Construction zones that once ran day and night now sit quiet, dotted with unfinished streets, empty lots, and model homes surrounded by dust instead of neighbors. Builders are offering aggressive incentives, $50,000 price cuts, covered closing costs, free upgrades, yet buyers remain scarce. The problem is not marketing, it is overproduction. Developers raced ahead of real population growth, assuming migration from Phoenix and California would never slow. When it did, the market was left with far more homes than qualified buyers. For residents who bought early, the consequences are severe. In half-finished subdivisions, promised parks, schools, and retail centers remain delayed or canceled. Property values have fallen below purchase prices, trapping homeowners who cannot sell without taking losses. Some buyers have walked away entirely, abandoning deposits rather than absorb further declines. Investors who purchase pre-construction units have been especially exposed. As prices slid and rental demand softened, many chose to exit rather than hold properties with rising insurance costs and uncertain appreciation. Even the rental market has weakened as workers choose to live closer to Phoenix's core instead of farther out. Buckeye's downturn is not a short-term fluctuation. It is structural. It reveals what happens when optimism outpaces infrastructure and speculation outruns sustainability. If this is the fate of Arizona's fastest-growing boomtown, what does that mean for cities built on prestige rather than scale? 3. Scottsdale. For decades, Scottsdale represented the top of Arizona's housing hierarchy. Luxury golf resorts, gated enclaves, and sprawling estates created an image of insulation from ordinary market cycles. Wealth, it was believed, could always stay ahead of risk. In Scottsdale, real estate was not just shelter, it was status. That belief is now under strain. Over the past year, home values in Scottsdale have fallen by roughly 18%, but price declines tell only part of the story. The deeper shock lies in the cost of ownership. Luxury insurance policies that once averaged around $6,000 per year are now pushing beyond $15,000. Homeowner associations are issuing special assessments in the tens of thousands to cover storm damage, infrastructure repairs, and rising maintenance costs. Property taxes, recalculated during the boom years, have climbed sharply and show little sign of relief. Even buyers with cash are pulling back. High-end listings now sit on the market for more than 200 days, forcing sellers to cut prices by hundreds of thousands of dollars. In exclusive communities such as DC Ranch and Silverleaf, homes that once commanded seven-figure prices are being quietly relisted far below previous expectations, and still struggle to attract interest. Investors have largely vanished. Corporate buyers and out-of-state speculators who once treated Scottsdale as a luxury playground have exited, leaving behind over-leveraged properties and increasingly anxious owners. What remains is a market caught between yesterday's prices and today's reality. For many longtime residents, the issue is no longer whether their home will appreciate. It is whether they can justify continuing to hold it. Rising insurance, HOA fees, and taxes are eroding the emotional and financial appeal of luxury living. Scottsdale's downturn is not loud or chaotic. It is quiet, deliberate, and deeply symbolic. When even the most prestigious markets begin to hesitate, it raises a difficult question. If luxury can no longer outrun risk, where does safety actually exist? 4. Mesa. Mesa was built on a promise of stability. As one of the largest anchors of Phoenix's East Valley, it marketed itself as safe, family-oriented, and reliably affordable. For years, growth felt orderly. New subdivisions spread outward, schools expanded, and home ownership appeared within reach for middle-class households. That foundation is now under pressure. Since peaking in 2022, home prices in Mesa have fallen close to 20%. With analysts warning that further declines are likely through 2026. But for many residents, the price drop has brought little relief. The cost of owning a home has nearly doubled in just 4 years. Annual insurance premiums that once hovered around $1,800 have climbed beyond $5,000 for many properties. Mortgage rates near 7%, rising HOA fees, and higher property taxes have pushed monthly payments into uncomfortable territory. The result is a market frozen by hesitation. Listings sit untouched for months. Sellers reduce prices repeatedly, chasing buyers who no longer feel confident enough to commit. Real estate agents describe a growing sense of anxiety, homeowners afraid to sell, buyers afraid to buy, and investors stepping back altogether. Developers are feeling the strain as well. Projects launched during the boom are now slowing or stalling, leaving partially completed neighborhoods and a swelling inventory of unsold homes. Rental demand has softened, removing another pillar that once supported prices during periods of uncertainty. What makes Mesa's situation especially revealing is its psychology. The city was never built on speculation or luxury. It was built on the belief that steady appreciation was inevitable. As equity erodes and carrying costs rise, that belief is fracturing. Mesa's downturn is not dramatic. It is quiet and persistent, a slow realization that affordability has slipped away, not because prices are high, but because the cost of staying has become overwhelming. If a city designed for the middle class can no longer support middle-class ownership, what does that mean for markets still clinging to the same assumptions? 5. Chandler. Chandler built its housing market on momentum. For years, it was branded as Arizona's tech success story, a city anchored by semiconductor facilities, expanding corporate campuses, and salaries high enough to justify rising home prices. During the remote work surge, demand intensified. New neighborhoods filled quickly, and prices climbed on the assumption that growth would remain uninterrupted. That assumption is now being tested. Median home values in Chandler are already down about 16% from their peak. High-end properties in planned communities are sitting unsold for months, even after significant price reductions. Builders have responded by cutting asking prices by $100,000 or more, yet buyer traffic remains thin. The slowdown is tied directly to the labor market. Major technology employers have paused hiring, reduced expansion plans, or shifted roles elsewhere. Construction activity has cooled, and the ripple effects are spreading through the local economy. When job certainty weakens, housing demand follows quickly. At the same time, the cost of living has surged. Energy bills are higher, taxes have increased, insurance premiums continue to rise. Even households earning strong professional salaries are finding that monthly housing costs feel heavier than expected. A payment that once seemed manageable now competes with every other expense. Investors are reassessing their positions. Some are renting at a loss to avoid selling into a declining market. Others are exiting entirely, adding to supply and reinforcing downward pressure. Developers quietly acknowledge that Chandler's ambitious smart city expansion may have moved faster than sustainable demand. What Chandler reveals is a critical vulnerability shared by many tech-driven housing markets. High wages can support rising prices until growth slows. When momentum fades, housing loses its cushion and affordability erodes rapidly. If a city powered by technology and skilled labor cannot maintain demand under higher rates and rising costs, what does that suggest about markets with weaker economic anchors? 6. Flagstaff. Flagstaff was long considered an exception. Elevated above the desert, surrounded by pine forests and supported by a mix of university employment, tourism, and second home buyers, it appeared insulated from the volatility affecting the rest of Arizona. During the pandemic, that perception hardened. Prices surged past $800,000, fueled by remote workers seeking space, scenery, and distance from major metros. That insulation has failed. Median home values in Flagstaff are already down roughly 17%, and local professionals warn the slide is not finished. The core issue is affordability. Income growth has stalled, but while borrowing costs have surged. A relatively modest $600,000 home now carries a monthly cost exceeding $5,000 before insurance and property taxes are added. For most local households, the math no longer works. The retreat of remote work has accelerated the shift. As companies call employees back to offices in Phoenix, California, and beyond, the stream of high-income newcomers has reversed. Homes purchased as lifestyle upgrades are becoming financial liabilities. Vacation rentals that once delivered steady cash flow are now sitting empty. Short-term rental occupancy has dropped below 50%, and listings increasingly outnumber long-term options. Owners who relied on tourism income are among the most exposed. Tighter regulations, higher utility costs, and softer travel demand have turned once profitable properties into losses. Many are rushing to sell, flooding the market with overpriced listings that fail to attract buyers. Developers have responded by shelving plans for luxury lodges and condominium projects as lenders grow more cautious. Flagstaff's downturn is revealing because it strikes at a market once seen as safe by design. Natural beauty and limited land were supposed to protect value. Instead, they magnified risk when demand shifted. If even Arizona's mountain refuge cannot hold under rising costs and fading migration, what chance do purely speculative markets have? 7. Prescott. For years, Prescott marketed itself as Arizona's retirement ideal. Cooler temperatures, pine-covered hills, and a walkable historic core drew retirees seeking relief from Phoenix's heat and congestion. It promised stability, quiet neighborhoods, predictable expenses, and a slower pace of life built for fixed incomes. That promise is now unraveling. From 2020 through 2023, Prescott's home prices surged nearly 70%, cresting above $650,000. The climb was rapid and unsustainable. By late 2025, median values had already slipped to around $530,000, and forecasts point to an additional 10 to 15% decline by the end of 2026. What changed was not demand alone, but affordability. Rising insurance premiums, higher HOA fees, and escalating maintenance costs have become overwhelming for retirees living on fixed incomes. Homes that once felt like a secure nest egg are now straining monthly budgets. Cash buyers who previously stabilized the market are demanding discounts of 20% or more, or walking away entirely. Aggressive construction has compounded the problem. Developments in Prescott Valley and Chino Valley, pitched as retirement-ready communities, now sit partially vacant. Streets lined with for sale signs reflect a boom that cooled faster than expected. Open houses that once drew out-of-state buyers now sit quiet. The deeper issue is demographic. The migration that turned Prescott into a retirement hotspot is reversing. Seniors are being pushed out by rising ownership costs, while younger families remain priced out and unable to replace them. The result is a market caught between two groups, neither able nor willing to absorb excess supply. Prescott's decline carries a sobering implication. If even carefully marketed retirement towns can no longer deliver affordability or security, what does that say about the future of retiring in high-growth states like Arizona? When cheaper homes still cost more. Taken individually, none of these cities tells the full story. Phoenix, Buckeye, Scottsdale, Mesa, Chandler, Flagstaff, and Prescott each appear to be facing different problems: luxury fatigue, overbuilding, fading migration, stalled tech hiring, retirement stress. But viewed together, a clear pattern emerges. This downturn was not caused by falling prices. It was caused by rising expectations colliding with rising costs. Across Arizona, the same assumptions repeated themselves: that population growth would always continue, that investors would always absorb excess supply, that insurance would remain a minor expense, that appreciation was inevitable. Each belief reinforced the next until none of them held. What replaced them was a harsher reality. Home prices began to fall, but affordability did not return. Monthly carrying costs stayed elevated. Insurance became a dominant line item. Taxes lagged the market on the way down. HOA fees rose to cover deferred risk, and as investors quietly exited, owner-occupants were left exposed. This is why the correction feels different. It is not a dramatic crash. It is a slow, grinding reset that drains confidence before it drains prices. Homeowners hesitate to sell. Buyers hesitate to commit. Builders hesitate to continue. And communities once built on momentum begin to stall. Arizona's experience is not unique, but it is instructive. It shows what happens when growth narratives outrun infrastructure, when speculation replaces sustainability, and when risk is priced out of sight until it becomes unavoidable. The question now is not whether prices will fall further. It is whether this reset marks the end of a cycle or the beginning of a longer adjustment that will reshape where Americans live, invest, and retire. If you're navigating these changes yourself, share your perspective in the comments. And if you want to follow how these housing shifts continue to unfold across the country, like the video, subscribe to the channel, and turn on notifications. The next phase of this market is already taking shape.